Welcome to Secure Money Mindset, the ultimate podcast for financial planning tips and strategies. Our episodes are designed to be concise and to the point, lasting no more than 30 minutes. Each episode features seasoned advisors from Secure Planning Group or an outside financial specialist discussing crucial issues and providing actions to consider when addressing your top financial concerns. We value honesty and transparency, meaning we present both the good and the bad news in a clear and concise manner. Our goal is to provide you with reliable insights and practical guidance. Be sure to hit the follow button to stay up to date with our latest episodes. For more information, please visit our website at securepg.net. Let's dive into this week's episode of Secure Money Mindset.
Hello, everyone, and welcome back to the Secure Money Mindset podcast. I'm your host, Mike Lenge, and I'm here with Marty Minder and Kevin Ralph, two of our financial advisors here at Secure Planning Group. And today we have a very important topic of long-term care. So without further ado, we wanted to jump right into it. We're going to start with Marty here, and Marty's going to tell us a little bit about what exactly long-term care is and why it's important.
Well, most people, when they hear long-term care, they think of a nursing home, right? So that's the typical first view. When it comes to long-term care, it could be a lot of different ways. You could have adult daycare, you could have at-home care, all the way to a nursing home. And so there's a lot of different avenues that when people get older, they have some, maybe early onset Alzheimer's or something. So you don't have to be that old for that situation. You're going to need a lot of monies to care for that particular client. So it comes down to this. You need either partial care or full-time care, and there's a lot of money to get either nurses to come to your home, or if you got to go to a facility, it's very expensive.
So talking about the cost of long-term care and why it's important to plan for it, can you maybe just kind of speak to how we view that as part of the financial plan, what the instruments are that we use to
Sure.
address it?
So I've seen that typically care starts in the home, and in the home care could be anywhere from $4,000 to $5,000 a month, depending on, does the nurse need to be in the home 12 hours a day? Does it need to be half a day? Does it need to be 7 days a week, 5 days a week? So all those things dictate how in-home care starts. But generally, as somebody's health or disease progresses, you tend to see that they need more around-the-clock care. So that could mean around-the-clock care at the home, which could be $10,000 a month, or that can mean them going to a facility where it could be as high as $15,000 a month. And obviously different facilities cost different amounts. The higher end facilities, the better care, tend to cost more money. But you could be looking anywhere from $4,000 a month for in-home care up to $15,000 a month or more. As far as the types of solutions that are out there, back in the 80s and 90s when long-term care first started becoming a problem, there was a lot of insurance companies that were trying to insure this risk. Problem with that is everybody's trying to lowball each other on who's going to provide the best premium in order to capture the business. It became a lot bigger problem than what a lot of these insurance companies had imagined. So that led to companies dropping out of the business altogether. That led to companies increasing premiums on clients throughout the years. They've retained the right to do that. They have, and they will continue to do so. So if you were that proactive person that got long-term care insurance at age 55, and you're trying to keep your expenses down, and now you're 80 years old, and all of a sudden the insurance company throws a 200% increase at you. Imagine that, right? You're proactive and you're getting penalized for that kind of thing. So those kind of policies have really left a bad taste in people's mouths. Not to say that they don't still, are in use today. They are, and I do think that the insurance companies have gotten a little better at pricing that. But what we have found is that products have been enhanced so much more. Little do people know you can actually get life insurance policies with long-term care riders. And what I mean by that is you could have a permanent life insurance policy and you have the ability to access that death benefit, on a percentage basis, on a monthly basis, to access that for long-term care needs, right? And if you don't need the long-term care, then your family or estate is guaranteed to get that death benefit back on a tax-free basis. So it's a really unique way to handle long-term care that not a lot of people know about. Again, opposed to the old traditional policies, it's use it or lose it. If you don't use it, which hopefully you don't need it, you lose the premiums. The life insurance policies, one way or another, your family's getting that money back.
And those life insurance contracts, pricing is locked in. They cannot change it going forward. But the traditional long-term care plans, my father has one and we're using it right now. So it's not that they're bad, it's just that the price increases are something you might have to deal with at some point in time.
Yeah, and I think it just speaks to, this comes up every topic we talk about, the importance of working with a professional. Because you see the advertisements on TV, you see the online services where you can go kind of self-serve when it comes to the life insurance needs nowadays. But if you're going on those kind of ventures on your own without a professional's guidance, it's very easy to be misled or purchase something that isn't what you expected it to be. Marty, can you maybe just expand on who long-term care would be a good fit for, or is it for everybody, is a simple way to ask?
I would say it's not for everybody. Typically, a long-term care plan is something you want to look at if you have assets to protect. If you think about it, there's Kevin had mentioned $15,000 a month. So you can do the math. You know, if you're in there for a year, that's $180,000 that now disappeared from your estate. So if you have a nice estate, you're going to want to try to protect that. If you don't have many assets, maybe that's probably not the route, because there's an added expense to that. If you have $50 million, then you can probably self-insure yourself. So pretty much everybody in between those things, you might want to look at and talk with an advisor about whether it makes sense for you or not.
That's perfect. What are some of the common, not mistakes, but what are some things that need to be top of mind when you're looking into this? Or what are some of the mistakes that people run into if they're not an educated buyer?
I would say the most important thing, we already said it, right? People don't have this conversation. I think it's like, less than 30% of people actually have long-term care insurance. So the first mistake people make is not being educated on it. And I can't say that's their fault, but an advisor should be talking with them about long-term care insurance. And if they're not, that's a problem. And then, like you said, selecting the wrong product, right? What makes sense for Marty might not make sense for me and you. Marty mentioned as far as ages that make sense for long-term care insurance. Nowadays we see people as young as 35 years old, 30 years old getting long-term care insurance because the products have enhanced. So even if they have long-term care insurance, if they're not reviewing it, that's another big mistake that I see a lot of people making. And just misconception. People think because we pay into Medicare that Medicare is going to pay for it if I need some kind of long-term care need. It's not health insurance, right? So it's completely different. And some people think Medicaid will pay for it. Medicaid does not kick in until you're down to very little assets. So just misconceptions that are out there is a big problem across the board.
And to your point there, like the quality of care as well is, I hear it from my own parents when we're talking through the conversation with them is, I don't care where I end up, blah, blah, blah. And it's like, until we go visit you, and it's a sad sight. And it's a sad topic to discuss, but it's
the old thing, it'll never happen to me. Marty mentioned his father. Unfortunately, my mother-in-law, we had to put into a facility at 60 years old. And she's been in there for 5 years. She could be in there for many more years, who knows? But everybody thinks it's never going to happen to them. And that's the biggest mistake right there, because, unfortunately, it's the biggest risk, if not, the second biggest risk a retiree faces is a healthcare need like that in retirement.
Yeah, a lot of people we do planning for, the retirement plan looks great until you throw in a giant medical expense for one of their spouses. And it could really put a giant hole in the retirement plan if you don't take a look at this.
Yeah, and I guess kind of one of the last questions to bring up is, and you guys are living it firsthand through your personal experiences with family, but on the other end of it, when you have the policy in place and you're going to use those funds for true long-term care, you mind maybe just touching on that a little bit?
Sure. My father's in a nursing home right now. I got him a traditional long-term care plan 20 years plus ago. And at this point in time, that particular plan is kicking out enough money to pay his monthly bill. So between that and Social Security, we're not touching any of his assets at all, and we're covering a $15,000 a month bill. So it's working basically as well as I could have imagined, and it's allowing. So I know my dad wants to basically make sure that his heirs inherit it, everything he worked hard for. And this is a way that we can now preserve the assets to go to his kids and his grandkids versus a nursing home.
Another thing that I'll just add, and this kind of coincides with mistakes people make, is not understanding the fine language in these contracts. There's differences between a reimbursement policy and an indemnity policy, right? So if somebody does go on claim, a reimbursement policy, you actually have to take your receipts and file them to get paid. So it's a pain in the butt for who's ever handling your affairs, but you actually have to have the receipts. If you have an indemnity plan, no matter, as long as your doctor claims that you qualify for this insurance, the insurance company will cut you a check. You can use that check to get a ramp built in your home. You can use that check to pay a family member to get up to speed with how to help take care of you. Any single thing in the indemnity plan, you get the check and you can use it for whatever you want. So two big differences in the type of long-term care policies.
And I think it goes back to, again, this, in summary, the importance of working with a professional who has experience, navigates these types of things with a bunch of other clients.
Got it.
Yes, sir.
Was there anything else that we didn't touch on that you guys think needed to be brought up?
But we,
The biggest thing is just be educated, right? Have the conversation, understand what's out there, and you're never too young, like I said, to have these conversations. You know, a lot of people think I'll wait till I'm in my 60s. As with any insurance, the earlier you lock this in, the lower the cost is over your lifetime.
and don't think you don't need it without talking to a professional first. You should definitely make that part of your agenda.
Well, I appreciate you guys talking through this with us. It's been super helpful. If you guys have any questions, feel free to reach out to us directly and leave a comment. And we appreciate you, or we hope you appreciate the content. Thanks again.
Thank you.
Thank you.